Welcome everyone back to another episode. Myself, Jay Frank, and I have my partner Jeffrey Kalafut here, and we are talking to Ryan Walsh from Hard Money Bankers. Ryan, thanks for joining us today.
Thanks for having me. Appreciate it.
Cool, man. So we want to talk about obviously hard money, the ins and outs of it, and kind of uncover some of the information to bring it to light to see how people can use it. And kind of go from there and do an introduction of what you got going on and how'd you get in the business, man?
Yeah, certainly. So I've been doing this since about 2017. I actually come from the corporate world prior to that, as at an NBC making apps. So I'm one of the people that like made just like a huge career transition into real estate. And I my brother's actually the one who pulled me in because I worked with him on a small business project that we started ourselves. So he's like, "You got the mentality to be a hard money lender. Give this a go."
Mhm.
And I could dive into like what that means, but there's different personalities in real estate, and the key is to find the business model that matches your personality. That's what we believe, at least. And hard money matches me. I'm a
Mhm.
numbers guy. I come across as charismatic, but like I would rather sit behind my computer, not talk to anybody all day. That's my style.
Yeah,
Not for
yeah,
everybody by any means, right?
yeah.
Um, but for me, just number crunching, and that's how I got into hard money. And it's been great. It fits my personality very well. Um, so that's how I got into it. My company, Hard Money Bankers, which you see branded everywhere. I used to have a backdrop, but it was like, all right, maybe it's a little overkill. But they've my partners. It's me, my brother, and two other partners. They started it back in 2007 when the whole real estate market
Per-
exploded. Right.
Perfect timing.
Yeah, couldn't be better.
Yeah. Well, it was a scary time, right?
Yeah,
So
yeah, yeah.
so it was like everybody was running from real estate, and they jumped in it. And so yes, perfect timing, retrospective.
Yeah.
But that's I mean that's a whole nother topic we can get into. That when times are tough, that's when people like such as my partners, their business explodes.
Hmm.
And now I personally think now is one of those times. Um,
Amen.
but yeah, so that's quick background on me. Been doing it for about 6 years, company for about 15 years. So we are true private capital,
Hmm.
and that means a lot in the hard money world, but I'm trying not to dive in too deep. It basically means my capital source is all friends, family, personal money. We have zero bank funds, zero hedge funds. So it is literally when if you give me a call and you say, "Here's the deal," I'm looking at it in real time with you, saying, "Yeah, I know this area. I like this area of
Hmm.
New Jersey or PA, and yeah, I can lend here. Let's do this. Let's go. I could close tomorrow." Right?
Right.
Like that's crazy, because people usually when you're all right, I'm probably diving. Let
Honestly,
me,
yeah, before we get too deep,
yeah,
just to anybody who doesn't really understand it, because hard money, what does that even mean, right? So like if
right.
you could just give us like a brief overview, what is hard money lending and how is it different from traditional lending?
Yep. So hard money is basically if you typically are an investor, so somebody maybe you're looking to get into fix and flips. You watch some HGTV and you're like, now's the time to do it.
And
Maybe you want to get a.
it's that easy
It's
too. All
that
right.
easy, right?
How much money has that show cost people in thinking they could become flippers right overnight? Yeah.
Yeah. You can't even count.
Yeah.
Probably in the billions at this point.
Yeah.
But yeah, so hard money is if you ever want to start your own business, you'd probably go talk to an angel investor, a capital investor, that kind of thing, to raise some funds, right? A hard money lender is somebody who's essentially that, except our expertise is in real estate. So we understand that you're going to go into a project, a fix and flip, and that we understand the value of the property you're trying to do, which is basically your business model, saying, yeah, I'm going to sell this product, and this product happens to be real estate. And we understand that. That's what a hard money lender is. We understand your business model, and we're going to be able to provide you funds for that. Same exact thing as an angel investor, same exact thing as a venture capitalist. Uh,
Right.
we just understand your business model. That's it. That's what hard money is in the real estate world. I mean, hard money technically is anything that you can collateralize. So maybe you have a watch, or maybe you have a car. I could technically collateralize that because it's it's an asset. It's typically an asset, I should say. It's not always. Um, and I can use that. I can put a lien on it, which basically means, if you don't fulfill your side of the bargain of the business, I have the right to sell or go after this piece of physical whatever it is.
Mm-hmm.
Um, that's our business agreement. Ours just specifically focuses on real estate. So I don't
Okay.
know how much watches are worth. I don't know how much cars are worth, but there are lenders that do those things, right?
Right.
Ours is just very specific to real estate. And that's
Okay.
what hard money is on a high level. It's just money for your business to go into real estate, to flip it, maybe turn it into a rental, that kind of thing. We're just funds.
Gotcha.
And typically, like, what kind of terms do you guys have and conditions that are associated with the hard money lending for you guys?
Yeah. So there's different types of lenders. You'll call them short-term, long-term lenders. I'm what's called a short-term lender. That's typically 1 year. So we give
Mm-hmm.
you up to a year to do the project. But there's other types of lenders out there that'll do long-term, maybe 5 year, 10 year, 15, all the way up to 30, depending on what you're trying to do. So if you're trying to do a fix and flip, the 1 year is perfect for you.
Right.
Because we don't typically, I mean, ask your lender, but typically the short-term lenders do not have prepayment penalties, right? So what that means is if you get in to your project and you renovate it in 3 months and sell it in another 2 months, you're only in it for 5 months, which
Mm-hmm.
means you're paying 5 months of interest, because all these loans are going to be interest payments. So if you
Right.
take out $100,000 loan, you're paying typically somewhere around 1% every month, which is $1,000 every month. Uh, but you don't have to stay in it for the full year. And that's what we always encourage you. Be quick, get in, get out, make your
Right.
money, get on to the next project. You'd be surprised by how once people sign this contract, they just kind of start taking their time. It's like, oh man, that is
Clock
costing
is
you.
ticking. Yeah.
Clock's ticking. Yeah. And you hate to see it as a lender, because it's like, I want repeat business. I don't want you to get in, get
Right.
beat up by a project and never come back to the industry, which happens quite a lot because of
I'm sure it
Right.
HGTV,
does.
right?
Yeah.
Right. Because you have skin in the game too. You're like you're kind of like all working obviously in the same team, and you guys you guys build your business on reputation and trust. So you're
Yeah.
rooting for that person as much as possible. And then when you see them kind of slow play it, you're like, what? Let's, come on, let's get things going here.
A
You know?
100%. Yeah. Yeah, absolutely. I mean, if I'm sending you an email saying, hey, just checking in, that's, my low key way of being like, yo, get moving on this. You're giving me money. Stop.
Get your
Yeah.
ass in gear. Let's
Yeah.
move.
But I mean, it's such a range of professionals that we deal with. We'll work with first time investors, and we'll work with people who've been doing it for 30 years.
Mhm.
It almost doesn't matter. The experience almost doesn't matter with how you're going to perform. Like you either have it, you're either somebody who's like, this is business, this is money, this is time, and I'm going to get this done, or you're somebody who's like, yeah, I'll get around to it tomorrow. I'll get
Right.
around to it tomorrow. Like
Yeah.
it doesn't matter your experience. You're either a professional or you're not. So
I think that transition into all different landscapes and all different businesses. You're either experience. Yes, is it a key factor? Of course, but it doesn't necessarily. It's not the driving factor to whether or not you're good at something or should
no,
be
that
doing something.
it's specifically in this, like that, you're talking like an expert can get it done in, let's say, 3 to 4 months. A
Mhm.
rookie who's has to go through some learning curves, which is totally expected,
Yeah.
should still be able to get it done in 6 to 8 months.
Right.
So you're talking about a 3 to 4% difference.
Okay.
That's it, right? It's not like you're talking like millions and millions of dollars difference between experience and non-experience.
Right.
Timeline wise, you're either professional or you're not, and even the best, it still takes 3 to 4 months, and a rookie can take 6 to 8 months, right?
Mhm.
So
All right. So just to recap, okay. So institutional money, um, it's going to be a lot slower, a lot cumbersome,
yeah,
and and a lot more like for instance, like a renovation loan from a standard bank. That's going to be, time consuming and it's like time is money. So you guys are going to move faster. You're in the deal, you're more involved, you're kind of obviously checking in, trying to push the thing forward as much as possible as the investor. You're looking on average as like a 12-month term, right? And then at the end of that 12 month, then there would be, either, correct me if I'm wrong, a cash out refi, pay you guys and be done, or they turn around and sell it and then pay you guys and you guys are on to the next project potentially.
Exactly it. Yep. And the key thing that you hit in there was time and how fast we are compared to traditional lenders. Because you're exactly right. If you go to a bank and there is a time and place for them, so we're not even really competitors with banks. We're like because we hand off deals to each other all the time because it's just certain scenarios that fit better for what kind of money we lend. I'm looking at the property itself, whereas a bank is going to be underwriting you as a person.
Okay.
And they have a process that it's been set up for 100 years that they're not going to change from that. And they shouldn't, right? They have a working business model. But that could take a month, 2 months, even 3 months with all the processing that it takes and all the different people that have to give the approvals. One thing goes wrong, they have to start over, right? And again, it's a working business model. Perfect. But if you're trying to flip maybe 2, 3, 4 homes a year, you just don't have that time. You can't wait
Right.
for it, especially in a market like this right now where, sellers are like, if you can't close in 2 weeks, I'm just moving on to the next buyer, right? Like they're not waiting for you for specifically investment properties. So you need somebody who can give you the funds very quickly and they understand what you're doing and you don't have to give them an entire business summary, every single property you're looking at. And that's probably the biggest difference between us and traditional lending is just how fast we can move. So,
Right.
I appreciate you pointing that out. That's the biggest difference between traditional and hard money. And then, yeah, you're a little bit more on a clock. So you have a year with us. And at the end of the year, it's called the balloon payment. You'll either sell the property, you'll refinance out, or just pay us back with cash. Yeah, that's typically what people do.
Gotcha. So with hard money, majority of the time, I mean, I think it's a fine balance. So with hard money, interest rates are probably going to be a little bit higher than
Mm-hmm.
institutional money. Would you say that? But at the
Yes.
same, um, in the same breath, you're saying that with institutional money, you know, interest rates might be higher with hard money, but you're losing 3 or 4 months of paperwork and time. So, in the end, what's maybe the interest rate looks a little bit scarier, but it's the speed that you're saving.
Yep.
And because, obviously markets can turn and everything like that. So, um, it's efficiency.
Yeah, absolutely. Yeah, I have a video that kind of breaks down those numbers. Not that I'm promoting my YouTube. I'm just saying. To your point, we used to be 14% for 1 year. We've come down a little bit, and people balk at that, saying, "Holy crap, 14%! That's crazy." Especially when interest rates were 2-3%, right?
Mhm.
But you're not getting a hard money loan at 2-3%. Those are your Fannie Mae loans, like a home buyer rates. So when you get into the investment world, banks know that. So even at the best, banks were maybe down to 6-7%. So people are like, why would I pay you twice as much on the interest rate? And it's
Mhm.
exactly what you said, because if you wait 3 to 4 months just to close, what does that 3 to 4 months mean to your bottom line? Right?
Mhm.
You have to really break that down. And then
Yeah.
on top of that, if they're going to take that long to close, I promise you, when you have a draw request, and a draw request is when uh, you've done some work on the property. Let's say you just did some demolition and framing. It's typical, a beat up house, or maybe you're just doing a light renovation. You just got some paint done. Fine. Now you have to put in a request to this lender and say, hey, got my paint done. Can I have the $5,000 that we agreed upon for renovation funds? Because usually there's purchase funds and renovation funds. It's usually how
Gotcha.
these projects work. Um, so now you put that request in, that bank is going to take another 3 to 4 weeks just to get you your funds,
Right.
another month. So now your whole project is delayed a month. So you're paying them an extra month of interest
Hmm.
because you were waiting for your funds. And there's like that's how it works. Or you go with somebody who knows how this operation works and says it's very important that you get your funds tomorrow or maybe the next day, right? Because we say 0 to 3 days is what we say, because we don't always get our inspector out the next day.
Hmm.
but zero maximum 3 days, right? And it's
Gotcha.
like time is there's just no other phrase that fits our business better, but time is money.
Right.
And you have to know how to calculate that and really factor that into what you're doing.
Right. Especially, you're talking about carrying costs as well, and that time adds up quickly.
Yep.
Um, I have a question. Are there any properties that you guys wouldn't even touch?
Sure. That's a good question. And we really, unless you're a cash buyer, we usually say the same to our clients. Um, so we're typically looking for properties that have a certain minimum value after it's repaired. So an ARV,
Okay.
after repair value. This is what you're going for as the investor of what you think it's going to sell for when you're done. So let's say you buy a property for 100,000 and you're going to put $50,000 of renovations in. As the investor, maybe you're saying, I hope to sell this for $200,000.
Hmm.
So net profit of $50,000. Now, what you're missing though is paying your lender, paying your holding costs, paying your realtor. Everybody gets a piece of the pie, right? So that $50,000 gap quickly becomes $20,000.
Hmm.
Maybe let's call it 30. Call it $30,000. But if one thing goes wrong during this project and that $50,000 renovation budget is now 60,000, okay, that comes out of your profits. Now you're down to 20,000. But the reason I'm walking you through this is because that's the minimum number that we look for is 200K on the ARV, because there's not a lot of room for error in those properties. So let's say you're working on a $500,000 ARV property and a $10,000 problem comes up. You can eat that and it's okay. But when you're in those lower end properties, lower value, I should say, not lower end, lower value properties,
Hmm.
there just isn't as much room for error. So you're actually
Yeah.
at a higher risk of possibly losing money. So a lot of those projects, and what I see a lot of times with new investors, which is totally fine, they're saying, I just want to do a light renovation on a low cost house, so there's not as much risk.
Hmm.
I understand the logic to all that, and it is valid to some degree. But what happens when you thought, I thought I was just going to change the kitchen cabinets and maybe do some paint, but you get behind a wall and there's mold, and now you can't get your CO permit, and
Hmm.
you're $15,000 over budget
Right.
instantly, right?
Right.
So the trap properties can actually be the lower ARV properties. Anything under 200,000 is when you can start running into issues where it's like, man, I thought I was going to make 40 grand and now I'm down 40 grand. It just
Right.
happens more in those properties than it does in the ones with more room. Because like the amount to repair a house, yes, it goes up depending on the value you're in, but it's not a 1-to-1 ratio. And maybe I'm losing you a little bit here, but
No, no,
like,
no.
yeah,
No, you're good. So just to kind of wrap my head around it. So you're saying that, say I purchase a house at 100 grand, you want to see after repair value of $300,000 or more.
yeah, 200 is our minimum threshold,
Right.
but we encourage you to be above the 300K.
Okay.
Uh, yeah, that's kind of our sweet spot's probably between 300 to 700,000.
Hmm.
Once you go above 700,000, now you're dealing with the other side of things, where it's like, these are typically going to be high end model homes where they want gold kitchens, right? Just to put it out there,
Yeah.
where it's like now you're dealing with different clientele and things like that. So there's just a sweet spot, a range, three to 100 to 700,000. So to answer your question directly, we typically don't lend on homes unless the ARV is going to be above 200,000. And we
Mm.
also encourage our investors to be looking at something similar, because there's just
Right.
higher risk. Because especially in those areas that are under 200,000, you could be walking away with $0 in value.
Mm.
Um, Especially since the market has boomed over the last 5 years.
Yeah.
What we're very cautious of as lenders right now is, are those places that used to be worth $0 that are now 2 to 300,000
Right. Yep.
in the right scenario, or wrong scenario, I guess you'd want to say, could those go all the way back down to zero?
Right.
And that's where it's like, we don't, as a lender, and a lot of other lenders are in this similar boat, where it's like, I don't know yet. I don't know yet. We need more time.
Yeah.
And that's kind of where we're at right now in the lending world.
Gotcha.
Hey, Ryan,
Um,
quick question. So, like, obviously, the after repair value is a big thing for you guys. It makes sense. In addition to that, like, are there any other criteria you use to evaluate your potential borrowers? You know, what else? What else do you guys look into for the specific borrower themselves?
Sure. Yeah. I mean, the four C's of lending. It's so we as our guidelines. So the first C is the collateral, which is the property itself, right? That is the most important to me. If you're talking to a traditional bank, that's actually kind of the lead. Let me give you this list of four C's, and then
Sure.
I'll explain the priority on them. So priority for me is going to be collateral, then character, which is you as are you a professional? Do I trust that you are going to do everything in your power to basically get me my money back? Right? That's what I care about.
Jeff is never going to get any money. Jeff's not getting any money now. He's character.
Well, then the collateral better be good. So, collateral, character, capacity, which is do you have the ability to do this project, which could be cash, meaning
So
do you have
reserves.
do you have reserves,
Right.
or do you have? I mean, some people are contractors and they're just like, I have all these materials in my house, right? Like I have the materials, so things like that. So there's things you can almost like replace with cash. Experience matters there, and then the last thing is credit. We do check credit. That's more. Uh, Sometimes we don't have to check credit if the client doesn't want to, but it'll help me push my numbers. So that's the order. You got collateral, character, capacity, and credit.
Mhm.
Banks reverse that. They're going to look at credit first, then they're going to look at capacity, then they're going to look at character, then they're going to look at collateral in terms of their priority, which is very interesting. Like it's funny. We look at each other. I'm like, how do you like that's insane? And they look at me and they're like, that's insane.
Right.
But both models work. So
Right.
um, so that I think answers your question. The most important thing for you would be character, though,
Yeah.
outside of the collateral. Just be professional. Have some of your diligence done already. It's okay if you come to me and you're just wanting to learn about hard money. That's totally okay. But if you're coming to me with a project that you've never even been inside, you've never even talked to the seller, and I ask you what's your renovation cost, you're like, I don't really know yet. It's like, I don't really know how to help you then.
Right.
Like,
Right. You
Right.
have to have the information to evaluate the project at the bare bones minimum from the beginning, or else it doesn't. What's the point of the conversation?
Mhm.
exactly. And I have to make very fast assessments. And it helps if you have your ducks in a row
Mhm.
because I may not remember you in like a month, but if you call back the next day, I'm going to remember and be like, yeah, you were the person who didn't really have their things together.
Mhm.
Yeah.
Right. And so, like, what does that do for me? Like, okay, I'm going to lower my loan size, maybe $5,000, maybe
Yeah.
$10,000. Right. I may not even know I'm consciously doing it. I'm just kind of sharing that, like, first impression matters.
It's the character aspect of your equation, you know.
Absolutely. Yep.
Yeah.
Yep.
That makes sense.
Mm-hmm.
Yeah.
You're
Um,
taking a risk. I mean, it's a huge risk every time you give somebody money.
That's right. Yeah.
yeah. Um, and that's the thing too. You're analyzing the deal. Also, God forbid something goes wrong, right? You don't want to, but you're gonna go after the property, right? Because you're analyzing the deal in the back end, and then God forbid it has to go to foreclosure or something like that. But you're trying to get your money back, right?
Yep. Yep.
Yeah.
Exactly. So that's when we're reviewing it, we are reviewing it as if we are the investor
Hmm.
because sometimes we will be.
Right.
With exactly what you just said. I mean, I can tell this story because happy ending kind of thing. We signed a loan with somebody and they got hit by a bus the day after signing. Like that story, you're like,
You can't even make that up,
you
man.
can't make that up.
You can't make that up.
Completely knocked out of commission, like full body cast and everything.
Wow.
Um, we still have a good relationship with this person, but we knew like, well, we don't want to like foreclose on this property, like, but he can't do anything. So in this particular, sometimes we do foreclose because like it's a lot of work to renovate
Yeah.
a house. But in this particular one, we were like, the numbers work. So we just kind of worked it out with him. We're like, all right, we'll do this project from here on out.
Hmm.
Um, and so that happens, meaning like we actually have to account for the signer disappearing day one for whatever reason.
Right.
So that means I'm reviewing every project as if I'm the investor here. And can I, if you as the operator disappear day one, can I still get my money back if by doing this project? So yeah, we absolutely are that's how we're analyzing it, as if we are an investor with you.
So worst case scenario, that's where you're going. Like,
Yeah.
do I if shit hits the fan, can we take this? Can we take this thing on? Interesting.
Yeah, I mean, people don't always think about that when they're talking to, like, how come you're only giving me 50% or whatever the amount is, and it's like, because I do thousands of these, right? So statistically, things are going to go wrong.
Yeah.
So I have to back my numbers out that route. I have to, like, if I was doing 1 to 5 loans, maybe I wouldn't have to, right? Because I could be maybe more micromanaging, hands-on, that kind of thing. But we can't with what we do. So we have to assume worst case scenario happens every time. I mean, you have to have insurance. You have to have, if it's in a flood zone, you have to have flood insurance. Even though I get it, it's unlikely. I can't take those risks.
Right.
So it always comes out of the cost of the buyer or the borrower. But that's just how we wouldn't be a business if we weren't doing that, and then there wouldn't be anybody to lending funds. So that's why, like, yeah, I get it. My numbers are always going to be lower than yours. That's always how it's going to be.
Yeah.
But
sure.
It usually, once you do a couple of them, and once you've had some things go wrong, you're like, oh, I get why the lenders do that.
Yeah.
Oh yeah.
So,
how much cash do you, because you see all these commercials or these ads or stuff on Instagram like, hey, I bought this house, no money down. I used someone else's money, flipped it, made 100 grand, that all that stuff.
sure.
But let's put that into reality.
Yeah.
You're because you also mentioned reserves, right?
Mm-hmm.
So you want someone to have some kind of cushion or cash on the side because like you said, you open up the walls, you have no idea. There's always a calculated risk in any of these projects you're going to do because you can't see through the walls. Maybe there's a foundational issue. Maybe there's something underground. Obviously, you're going to do your due diligence before you close, but to say you can see everything all the time would be unrealistic.
Mm-hmm.
So, what kind of cash amount would you say? Do you have a ratio, a percentage of, or anything like that? What would you say on that?
Yeah, so I get those calls quite frequently. Like, is it true? Can you really do 100% financing? So there's different ways you could do it. One, and this is the most common way, although it's probably not very rookie friendly, is you use a piece of property that you own outright as additional collateral. So let's say you own 123 Main Street and you're looking to buy 567 Main Street. I can use 123 Main Street as additional collateral in replace of cash. So that I could get to 100% financing. But the question you're specifically asking is typically a first time investor, right? Like they were brought into real estate being like, I heard you could do this. Yeah, it's possible. It gets more and more rare as time goes on. You're probably not going to get 100% financing from a lender. But what you can do is find an awesome deal and get a private partner who's going to cover your down payment. So technically, it's not your money. You're basically combining. Let's just say I'm able to bring 80%. Let's just the total project, and you need to bring the other 20%. Well, you can talk to a partner. Maybe you met them at a real estate event. Maybe however you know them, it doesn't matter. But they can bring that 20%. And now, from your perspective as the investor, that's 100% financing. You haven't put a dollar down. That's the only way I've ever seen it done. But you're not going to see a lender, especially in today's environment, giving you 100% first time environment,
right?
Or first time flipper. So if they're asking for upfront cash, run away. That's a scam. Yeah.
Would you recommend anyone getting into a loan shorter than 12 months?
Probably not. It's kind of like a talk to your lawyer kind of question there. So I do want to be careful with what I say. There are times where it does make sense.
Okay.
But then there's that for me, from the people I know that do those types of lending, sometimes it can be a little predatory, and they might be going after certain people, knowing they're going to fail,
Right. Setting them
because
up for failure.
setting them up for failure. That does not mean all of them, though. That's why I want to be careful with what I'm saying. Like
Okay.
there can be times where it makes sense. If you are a new investor, I would probably steer clear of that. Maybe 9 months is, that's not a big deal. But if they're really like 3 months, 6 months, like I probably wouldn't do that as your first time.
Right.
Especially when there's people such as myself who's like, there's no prepayment penalty with what you do.
Right. So
So
why not take the 12?
why not take the 12? Yeah,
Right.
exactly. Yeah.
Yeah. Yeah. For those unforeseen things that pop up and, you need an extra month or anything like that. But what happens what's it look like if someone needs to go past 12 months?
Yeah. So hopefully you've been working on the project, first of all, as long as that's the case, as long as you've been talking to us, you're in good communication with me, and you're just like, hey, things got happened. The township took forever. Um, I'm gonna need another couple months to sell the property. I'm gonna do my best to work out an extension with you. We don't want to go through the
Gotcha.
foreclosure process. We don't want to,
Right.
or most lenders don't want to, I should say. We are one of them because it is a lot of work, and that's not why we're in this. We just want to put our money out and get our money back.
Right.
That's it. So
Right.
foreclosures work. So we do try to work out things with you. Usually what that looks like is, okay, it's going to cost you. It's usually not free. Maybe I can get you the first month free, that kind of thing. You just keep paying interest. But after that, it's usually something in, how much time do you need? Well, I need 3 months and I need 6 months. Okay. Depending on how much time you need, I'm going to go talk to my partners and say, hey, John Doe or Jane Smith is been doing great on this project. They ran into a couple hiccups with the township. They just need another month or two to sell it. Let's get them a 3 to 4 month extension.
Mm-hmm.
And usually what happens is it's going to be a percent, some sort of percent, maybe 1, maybe 2% added on the payoff. So,
Okay.
so you're not coming out of pocket. Now, if you go into a third or fourth extension, now I might ask for some money up front.
Okay.
But for, it's rare. It usually doesn't go that far. But yeah, we
Right.
always try to work out extensions.
Gotcha. So you're saying like on average, say, it's obviously a case by case basis, but the interest payment would stay the same. You would just add points at the end to the payoff.
Exactly. Yep.
Okay.
That's the ideal scenario. Because if you stop making payments or anything like that, now it gets defaulted interest, and that's when your interest rates can double, and it goes on your credit report. So it's like you never want it to get to that point.
Right.
So yeah, extensions are ideal.
Right. And obviously, you guys, correct me if I'm wrong, you're not, I mean, necessarily regulated by any, federal institution, correct? Like it's kind of like the Wild West where you guys make up it's your private money. You make the rules. You go, is this a safe bet? Is this someone I want to get, do business with or be partners with or even be in this deal? You guys get to dictate how you want to operate your business, correct?
100%. Yeah. So that's another big difference between basically primary lending and the hard money world. So back when 2007, 2008 happened, a lot of regulations came into play from the government. Some existed before, but obviously it wasn't very good. But
Why
A
would
lot
you
of
say
those
such a thing?
they needed to come into play though. It was nuts back then.
It was my opinion, because I actually have my NMLS license as well. I don't do it. I don't sell primary though. But anyway, I think they went overkill, and now it's like there's too much regulation. But that's kind of to be expected. But it's okay. So point being though, there's so many regulations and laws that primary residence lenders have to follow, whereas if you're on the investment side, and it's a very clear delineation in the courtroom, it's consumer versus business. And a flip, a rental, those are all business. So as long as that's the case, I can put whatever I want on this piece of paper. And if you sign it, we're in business together. Now, I do think there is still usury. So meaning you can't go above. Every state's going to be different, but let's just say it's 30%, something like that. Well, we we haven't had to worry about that. But there is a very limited regulation, and that's about it in terms of the hard money. So you definitely want to review the loan docs. Know what you're saying. Most people don't. It's crazy. Most people don't. Fortunately, we're good people, but I know that's not always the case, and people don't realize what they're signing. But yeah, I mean, when you close on our loan docs, it's a $750 legal fee, and I always tell everybody that is our legal fee. They protect us as the lender.
Right.
You need a lender to look at the documents to protect you. So keep that in mind for sure.
Interesting.
Ryan, how many do you guys have like a threshold of how many projects you'll have going at one shot?
I wouldn't say a project number. It's more a dollar volume. We usually have about 50 million deployed at any time, and it kind of just cycles from there. I mean, we have the ability to go higher than 50 million, but with our tolerance, it just kind of floats like probably about like 10 million in, 10 million out a year. It kind of just sits around there. Sometimes it can go up to 20. When I say that, I'm talking about like per partner.
Right.
It's kind of like a per partner capacity. So it usually floats somewhere like, let's see, like last year was probably about 45 million, but then 2022 was about 60 million, right? So like it ranges. That's typically what it is. It's more a dollar amount than I would say project amount.
Gotcha.
Yeah.
Where are you seeing most of the money going? Like what states? Like what states are you seeing the most activity?
Well, we're local lenders.
Yeah.
So my view there is really just the mid Atlantic, North Carolina, then we go up to Virginia, DC, Delaware, PA, and New Jersey.
Yep.
And then of course, what's that?
No, I was gonna say, like, out of those states, what are you seeing the most activity in, you think, right now?
It depends. It depends on the type of project too, right? Like in general, uh, fix and flips are down, I would say,
Okay.
just in general. Like a lot of what we do right now is actually refi still. Because I know when people think of that, they're thinking like primary residence refis, and they're like, what? I thought refis are way down, and they are in the primary world. They're like non-existent. But in the investment world, you get a lot of people who are saying like, I need to tap into my equity. I know the rates aren't 2 to 3%. I know they're higher, so I just need a quick bridge loan to maybe fix something in my business, and that and I'll have it paid off in the next 6 months, kind of thing. So I'd probably say there's a lot of that going on right now. I mean, still fix and flips, but I can't really tell you. Like they're all pretty even.
Right.
To answer your question directly, they're all pretty even. I can tell you, I get a lot of Florida requests. We're not there. So a lot of people are definitely still trying to go to Florida. That I can say.
For sure.
But
Talk about the Wild West. Florida's the Wild West,
yeah, like the Wild West. Yeah. But yeah, in terms of all those states, they're all pretty evenly hot. Very active still with what we do. Thank God. It's just we're built a little bit differently, and I don't even know if this is valuable to your listeners, but we're a small like mom and pop shop kind of thing, so we don't need to do $1 to $2 billion in volume to do well for ourselves. So because we don't have staff and things like that, so there's a lot of lenders out there that are hurting. And that's because they were built for like when things are just churning and churning and churning. When the screeching halt happened in 22, I'd probably say basically as soon as the Fed started increasing rates, like a lot of lenders went out of business. And I don't know if they're going to come back, especially with the shortage of housing right now. That's I don't know if it's a tangent or too much of a tangent, but that's kind of where we're at right now. Is just we don't need to do a volume game. We just do the right deals for us and move on.
Quality over quantity.
Absolutely. Yep. Exactly. And I think that's a lot of the investors right now. It's not a massive numbers game right now. It's just the quality, like you said. I think that's where we're at.
Yeah, I think so. Like you mentioned earlier, too, it's like obviously no one can predict the future or what's going to happen, and you're saying like the lower price point areas that have reached a higher price point now. Like, are they going to last? Are they going to last? So you don't want to get caught with too much money handed out, and all of a sudden like, uh-oh, we're in trouble. So
That's exactly it. That's exactly it. And I do think there's a lot of lenders right now that have been holding their breath for the last 2 years.
mm,
They've kind of been saved in the sense of like price held
yeah,
somehow, some way. Price is held. So they're not getting crushed right now. If that dipped even like 10-15%, they're
mm,
out. They're done. They're not coming back.
wow,
So we're still in that holding pattern. That's what's very interesting right now is
yeah,
people are starting to feel optimistic about the future right now, and I think that's just tenacity wearing out. They're like, well, nothing's happened yet, so I think it's going to go up. I
mm,
think I think we're still in a waiting game.
mm,
And I don't know what it's going to take. I have no idea how long. Like, can we sit here for another 5-10 years? I don't know.
either.
So
That is to be told.
to
That's
be
it.
told, yeah.
The million dollar
Until then,
question.
though, I don't risk money, right?
Yeah,
So
yeah,
that's where we're at right now. Like people are like, why aren't lenders lending? It's like I need the data. I need the data to show me one way or the other, and
right.
it's sitting right now.
I think that is this, like you said, we've kind of like been coasting there for a few months, for a little bit now, and we're like, it's better to know what direction we're heading in. All right, we're in a down market, we're going up, but like that's unknown, that uncertainty of just like, hey, it's been kind of even keel for a little bit. What's happening?
Yeah,
Um, so what's peeking behind the corner for sure.
yeah. I wish I had a better crystal ball for people, but the only thing I could say is where I put my money, and that's I always assume worst case scenario. So it's like, yeah,
Yeah.
I know my numbers aren't as good as they were 2 years ago. Um,
Mhm. But
check
there's a
check
reason.
back in a couple months. Maybe I will be right.
Yeah.
Right, right. Join the club.
Yeah.
Yep.
This whole industry is taking a weird turn. So,
Mhm.
Absolutely. Yeah.
Um,
Brian, I wanted to go back on something that you mentioned before, and I wanted to ask. You're talking about evaluating the properties, and you have somebody that goes out to take a look at them. Like, what does that look like?
Well, in terms of evaluating the property, that's going to be me. So I'm the Jersey guy. I do
Okay,
North Carolina now, and then my partner, like we're local, right? So we know the areas of our states that we want to be in.
okay,
So I do my desktop comping, and that's pretty much what I do at this point. And I know where I want to be, and I know what type of neighborhoods I want to be in, that kind of thing.
okay.
mhm.
And I can typically pin the value to it. Now, the part where I send the person out to the property, that's literally just to verify all my assumptions. So if I've talked to you as let's just say you're the client and you're
Right.
like, yeah, it doesn't need that much work. Uh, well, first of all, I'm already building in buffer room for
Yeah, you're
when
like
you when
5,000 off.
yeah, yeah,
Another five.
yeah, exactly. But let's just say I am going with you on what you say. My
Mhm.
person's going just to snap photos. They're going to verify the condition that you said. I mean, we've had people try selling us burned down homes, right? Like
Right.
after telling us it's a great home.
Right. Just needs a little paint.
Yeah, just a little bit. That's right. Uh, so that's all they do. Now they do give us a BPO, a BPO is broker price opinion. So
Yep.
they'll give us just a quick like, hey, here's the comps I'm seeing. We do that as kind of a triple check kind of thing. Just
Yeah.
Sure.
make sure there's not a huge difference, but for the or not for the most part for every single time, whatever number I gave you, we're good to go. Like because some lenders, in fact, most lenders use appraisals. So this
Mhm.
will probably be good for your audience to be aware of. So a lot of times the lender will say, hey, I will get you, using basic numbers, $100,000 purchase and $50,000 renovation. They'll tell you, hey, I'll get you 80,000 on the purchase and 50,000 renovations. You're like, that sounds great.
Mhm.
I'm bringing 20,000. That's pretty good. What they don't tell you is that's contingent upon this appraisal come back at a
Mhm.
certain value. So as soon as it comes back a little bit lower, now they're saying, oh, we can actually only give you 70,000.
Mm.
And maybe we have to rewrite the file now because it's been 2 weeks, right? So like there's a whole process that could come back, and all of a sudden, where you thought you only had to put $20,000 down, now all of a sudden $40,000 in and your interest rate's 3 points higher than where you started. So that's most lending. It's pretty unique to find somebody in our situation where it's like, hey, I gave you this number right now. I know we spoke 5 minutes ago, but that's the number. So that, I mean, most of my repeat clients, they've all left me at some point because I'm relatively expensive. So I'm a little bit over 12%, and people, once you've got a couple flips under your belt, you can probably get 11% right now. And that 2%, I understand. I'm not mad at these people for shopping and whatnot. Like I just leased a new car. Like I get it. I called every dealership. I get it. I'm a person. I get it. But they always come back and they're just like, oh my gosh, I'm so sorry for leaving you. Like it's amazing that I can just give you this project, you give me your number, and we go. There's no games. It's just this is what it is. And it is what the industry is. Sometimes you just kind of gotta go through it to understand it. But
yeah, I think it goes back to that old saying that, you get what you pay for kind of situation, right? It's quality over quantity, right? Is that one point costing you nonsense in the back end to where you have a smooth operation? So, and it's the same thing. Like if you find a good contractor, a good plumber, a good lender, you hold on to them. Maybe it costs a little bit, but it's going to save you in the long term if you're serious about something and about establishing a business and operation. So, yeah. And having like a weak linchpin in there is like, it could be detrimental. It could ruin it.
Yep. People always ask, like, do you have any contractors you could recommend? I say yes, but no, I'm not giving out the good ones.
Right. So Ryan, how about those contractors?
Yeah.
We'll
it's one inside tip I won't give.
Cool. So Ryan, let's break it down in the simplest term. If somebody brand new wants to get in touch with you, and then what should they be prepared to give you? Is there a form that they fill out before they talk to you? Like run us through that process of how it works.
Yeah, I probably spend more time explaining that they don't have to do anything. They could just email me or call me. They're like, "What do you? There's no application." Like, nope, you don't. I mean, you can go to our site and fill out this page. It's gonna go to me, or you could just send me an email or text. I don't care. I just need the address, purchase price, and renovation cost. Those are the three things I need. That is it. You don't tell me anything. I don't. Yeah, I mean, you can tell me whatever else you want, but I'm not paying attention at that point. I'm just telling you, okay, you sent me the address, you sent me the purchase price, you sent me the rehab cost. Give me 5 minutes. I'm going to go do my thing. I'm going to make sure this is a project I can help you out on. And then I'm going to send you back some rough terms saying, I haven't even asked anything about you yet. I'm just going to say, I'll be at around 80,000 for this project, and I'll give you 50,000 for renovations. Would something like that work for you? And let's just say the answer is yeah, I can make that work. It's like, all right, cool. Let's dig in. Have you seen the project? What's your credit like? Do you have any experience? And that's pretty much it. Like I can figure all this out in about 2 minutes. It's literally all it takes.
I want to back up a little bit. So obviously the first part is just opening the door to see if you're even intrigued and you're like, maybe there's a possibility we can work together. Then the second phase is, you're starting to factor in character of your analysis almost. And then you're also, my question too is like, okay, these people are coming, these potential investors are coming up with renovation costs. How are you checking that? Like, are you, because some people have a clue of like what things cost and some people don't. Are you looking
Most
for
people don't.
Right. Are you looking for like an invoice or like a contractor's been there and they give them an estimate, or like what verifies that renovation cost and makes you okay, I'm okay with this?
Yeah. So, I mean, part of that is probably just comping and doing thousands of these where you just know. So if you gave me the address, now I'm able, because I have MLS access, I'm able to find, okay, I know the square feet, I know this neighborhood, I know what it's going to take for, let's just call it 1,000 square foot home to renovate that in that neighborhood. It's going to cost at least 40, maybe 45,000, right? I know that. If your number is 20,000, I know you're 20,000 off, right?
Mm.
So that's okay. Your numbers don't have to be perfect yet, but do know that I'm lowering my loan size by 20,000. So I'm putting that risk on the client. And
Got it.
so it's every project's going to be different. So in that scenario, let's say I normally would have liked to have seen them with a reserve of 20,000. Well,
Mm.
I know they're $20,000 off, so I'm going to say I need to see 40,000 from you, and they're going to say
Gotcha.
why? Like what's your percent reserve? I'm like, it's not a percent reserve. I
Mm.
know how much you need to be able to perform on this project. Maybe I'm wrong, and I overestimated. That's
Mm.
okay. I can't underestimate though,
Right.
right? It's okay. It's okay to be on the right side of wrong, is what we say, right? So that's kind of how there's no flat number. I mean, banks will come back with a flat number and be like, you need 10% reserves. For me, it's every project's different. It's
Mm.
where your numbers are. Very, very rarely do people overestimate renovation budgets. It
Mm.
does happen, and the words I love to hear are, "I can probably do it in less, but I built in some reserves."
Nice.
Like, perfect.
Yeah.
That's
Yep.
that's what I want to hear.
Because you're doing that anyway, right? So
Yes.
if the investor's doing that as well, like it's just a better safety net for
Yeah, it's
everyone
added
playing the
security
game.
for everybody.
Yeah.
Yep. It kind of, I mean, it's funny how like one question or one answer checks all these boxes under character, capacity, and even collateral, because now I know you're going to do a proper renovation on this property. So I can push my number. Like, I'm like, yeah, you're going to get that 400K ARV with that
Mm.
type of renovation, but you're not
Mm.
going to get a 400K ARV by just doing a paint job. So,
Right.
it's just, it's funny how all like one question can
Hmm.
like renovation budget's probably the most important number to get right.
Yeah.
But I mean, there's three numbers. You got your as is value, which is going to be your purchase number, um, super important. Your renovation, and then your after repair value. Those are the three numbers. You master that, you've mastered real estate.
Mm.
Um, and the entire story is told off of those three numbers.
Right.
Everything's connected. Um, so it's hard to give like a blanket answer of like how much reserves should I have. I'd say at least 40,000 is probably just a like it almost doesn't matter the size of the project. You
Mm.
want at least 40,000,
Gotcha.
which could be a target goal for a lot of people getting into this. So if you don't have that yet, that's okay. Wholesale some deals, find a partner, but 40,000 is probably, even if you're doing a smaller project, 40,000 will keep you safe. And if you're doing a larger project, 40,000, it's just kind of like a magic number, I guess.
Hmm.
Um, but again, it varies depending on what your budget is and things like that. But 40,000 is a pretty good number to start.
Gotcha. So email, text message, phone call to you.
Yes.
You respond, you say, "Hey, I probably can give you this." Um, the investor says, "Okay." You're like, "All right, let's talk further." So
Mm-hmm.
and then you start digging more, deeper into the deal. You start seeing, how legitimate is the renovation costs and stuff like that. And then you start going into character and potentially collateral or assets or credit report. You start digging deeper into that. And then obviously the conversation continues, and then you would make a decision whether or not to move forward with the deal or person at that time. Am I off at all on
Nailed
anything?
it. Nailed it.
Okay.
Yeah.
And
Um,
Yeah.
how soon, Ryan, after that conversation takes place and you're like, yeah, we can do this, how soon can the person have the money in hand?
So the one thing that is needed is a title search. So this is for anybody who doesn't know what that means. It's when there's companies out there called title companies that they will verify that this property is owned by the seller, John Smith.
mhm.
They will verify there's no additional liens on the property or judgments. There's a whole list of things. There's a whole list of things that this title company makes sure that in your purchase you're getting that property and you don't have anything else behind it. And that is what we need as a lender. So as soon as title is in, we could close. Sometimes you've had title rant before you've come to me and you're like, yeah, I got titles ready to go. Okay, we can close tomorrow. Let's Put me in touch with your title company. We'll wire the funds over. We're good to go tomorrow. For the most part, people have not ran title yet because they want to make sure they have the funds lined up. Totally
Right.
fine. So once I say, okay, let's go, then you'll put me in touch with the title company, or I could recommend one. And usually 5 to 10 days is usually how long it takes for a title company to do their search. I mean, they literally just go to the county and get records and things like that. They may have to reach out to, there may be an old mortgage from 10, 20 years ago. They have to reach out to the company to get a payoff. So there's things like that that get done. But for the most part, 5 to 10 days from there. But
Awesome.
yeah.
Nice. Yeah, I think the biggest thing people title, there's a lot of scams out there online about properties, and then all of a sudden you find out that that person doesn't own that property, and it can get messy pretty quick.
Yeah, yeah, I'm uh, dealing with a couple good ones right now. Just a guy. Fortunately, we're in first position, but he tricked a lender, so he had two first position lenders, us and somebody else, and
Wow.
it's literally a timing issue. So which title company recorded it first? Ours did, so we're safely in first. If we
Wow.
weren't, we'd actually have to pursue the title company. So I feel bad for the other lender, behind us. They didn't really do anything wrong morally, but they trusted this person too much. That's
Mm.
what happened, and so yeah, those situations happen, whether it's the title company or even our borrowers, they can pull fast ones. So title companies
So,
are
I mean,
huge.
so what was the angle on that? Trying to get, two lenders just to pump the bank account and then take off? Is that?
Yeah, basically. So our loan was about 400,000, and the property's value when it's done is about 900,000. So he got another lender to give him another 400,000. So for the most
Mm.
part, lenders won't take second position. Some will take second positions, meaning they'd be behind my loan. So he
Yeah.
wouldn't have gotten another 400,000 though. Maybe a second lender would have been like, I'll give you 100,000,
Mm.
right? So instead of getting 500,000, he got 800,000.
Hmm.
So I mean, it's
It's a
it's
lucky.
wild.
Yeah, it's crazy, man. We're coming up on an hour. Is there any, Ryan, is there any particular thing that you wanted to mention before we, hop off here? Or Jeff, you have any final thoughts or anything like that?
Yeah, I mean, I'd say stick with it for most people right now. I think a lot of people are getting discouraged out there. They put a bid in and they lose it.
Yeah.
Just stick with it right now. This is the stage of it's a war of attrition, right? Anybody who survives through this is going to be the big name in 10 years that you're watching videos on now, because you
Mhm.
have to go through something like this. So hang in there. And come up with creative ways to find these deals, right? This is the time when creativity comes out,
Mhm.
and new industry wide things start happening because somebody did something. Like, I mean, even Zoom calls, right, with clients, like that was
Mhm.
unheard of. Now
Right.
people are buying and selling homes via Zoom. So you just find creative avenues and keep putting those bids in, and you'll 5-10 years from now you'll be making all these videos.
Nice, man.
Awesome. Ryan, what's the best number to reach you at? And we'll put your information in the
Yeah.
description as well.
And your
Sure.
YouTube link. And your YouTube link. We'll put that in the description as well.
Cool. Yeah, sounds good. My cell phone is 201-345-1036. Reach on out anytime. Email Ryan, Ryan, at hardmoneybankers.com. I'm always working, it's part of having your own business. So reach out anytime. Happy to answer any questions you might have, talk about any projects, and we'll go from there.
Awesome.
Awesome.
Ryan, thank you so much. It was a great conversation, great information, and really appreciate your time for jumping on.
Jay,
So
Jeff, appreciate you guys, and looking forward to having you guys on our show. So
let's do
Can't
it.
wait.
And I definitely look forward to continuing this conversation on different topics in real estate investing. That'll be great. So that'd be awesome, man.
absolutely appreciate it. Anytime, guys.
Awesome.
Take care.
Thanks, Ryan.
Later,
Later.
buddy. Bye.